Hello everyone, Kieran King here and welcome to this new video. In my professional line of work, so my day job, I come across many applications to raise money, especially from early stage businesses or startups. And due to the sheer number that come across my table, I need a quick way to sort of analyze them, filter them out, and basically evaluate those businesses so I can make the initial decision to say, yes, I want to look at this business a bit more from an investment perspective, or no, it's not really for me. So I've created a free 2-page document that you can download in the link below if you wish, which is basically a fact-finding guide to a potential opportunity you are looking at. Founders, CEOs, business owners, they may omit or leave out certain bits of info in their investment presentation to you, and they may exaggerate certain bits of info in order to effectively sell you the opportunity. Your job as an investor is to look at it completely objectively, see if it marries up with your own investment objectives, and then make a decision based on that. So in this video, I'm going to go through this checklist that I've put together so you know exactly what to look out for when considering an investment in an early stage company or a startup business. This is also a really good exercise for founders or business owners who are out there raising money, as you can see the sort of questions that a VC fund or an angel investor might be interested in finding out, and you can answer them and prepare to answer them accordingly. If you want to go through this document with me as I talk about it, then do click the link below, sign up and get your free guide. So let us crack on. So I'm going to use a fictional example of a company in this scenario, and let's say that they've walked into the room and they're pitching you their idea. Okay, so we're going to go through this checklist and sort of see and gather all the information we can about this company, so you can go away, think about it a bit deeper and make your decision. So the first thing I'm going to do is put the date so I know when this pitch was made to me. So in this case it's the 31st of March 22, and I'm going to write the name of the company, the legal name of the company that's pitching, and we're gonna be a bit out there today. I'm going to say this company is a company that manufactures and builds and sells jetpacks, okay, for the everyday consumer, the everyday person. So I'm going to put the info of the company name at the top, and let's call this company Soar the Skies. Limited. All right, be a bit creative there. We also want to know when it was incorporated. So actually the legal name allows you to go check with Companies House or the relevant company's directory in your own country, and you can check this information against that. So, and now we're going to find out the date of incorporation. When was this actually started legally? And we'll say it's been going for 2 years. So let's say it was started at March 2020. Okay. Country of incorporation, I'm in the United Kingdom, let's just say UK. Industry sector, let's say consumer goods. All right. It wasn't introduced by anyone, it's come directly to me, and it's presented by their CEO, who in this case is John. We put his contact details in, let's say John at soartheskies.com, his number, whatever that is, and the website, soartheskies.net or something like that. Forgive me if there's a website Soar the Skies out there. This is just purely for an example. Okay, so we've got this headline information that we can just when we're flicking through all these opportunities that we're looking at, we can see directly at the top, right, okay, what is it? Yeah, Soar the Skies, blah, blah, blah. Okay, what industry it's in, who was the guy that I spoke to who presented it? Yeah, you've got a website there, fine. And what's important actually is, as we're going through this document, with every fact that you find, okay, you need to ask yourself, this is a really good exercise, you need to ask yourself, so what? Or what does this mean for me? And what does this mean for the opportunity? Okay, so it's all good gathering this information, but now what does this information mean? How do I apply it? So for instance, we could say, let's look at the name here. The legal company name is Soar the Skies Limited. All right, Soar the Skies, is that copyrighted at all? Is there someone else doing it? Is there someone else with that name in a similar sector? Okay, this is the sort of stuff that we can start to extract from this fact-finding mission and analyze. Okay, moving on to key commercials. What is the actual structure of the deal? Let's say this deal was straight equity, okay? Meaning they're getting investment and they're giving a percentage of their business for that investment. And so we'll tick this box to make it clear that's what we're after. But this needs to also tie in with your own investment objectives. Are you looking for equity because you want to grow the business? Maybe maybe you don't. Maybe you want to, you just want to get a bit of interest or a coupon each year. So you're looking at a debt deal instead. Almost always for a startup, in my personal experience, I structure it the deal usually as a convertible loan because it's a mixture of both debt and equity, and it means that if things go wrong, we can step in, we can convert that debt easily and take a bit more control of the business. Okay, and there's other as well that I've put there just in case there's another type of deal that you're looking at, maybe an equity loan note or something like that. Okay. So yeah, next we look at the pre-money valuation. Okay, so this is really important as this essentially determines the price that you are paying for the percentage of equity in the business. All right, so let's say that they've said, all right, that their pre-money valuation is £10 million. All right, their business is worth £10 million is what they're saying right now. And the share price that they are selling shares at or issuing new shares at is £10 a share, let's say. Okay. All right, and the number of shares that they have in issue is therefore, if you divide 10 million by £10, you get 1 million shares. Okay, that's how many that are currently in issue. All right, and they want to raise 1 million. Okay, so they're raising 1 million, adding it to their valuation of 10 million, which is 11 million, which is their post-money valuation. All right, they're offering 9% equity for that, and the total raise, as we just said, is £1 million. Okay, and let's say there's no tax relief in this deal. All right, so that might be an important thing you're looking at. Especially in the UK, we have EIS and SEIS schemes. For startup businesses, you can essentially offset your investment by sometimes about 50% against your tax bill. So that might be an important aspect for you. Now, all this information is really important because when you do your DD on this company later, you can look at it and be like, actually, is it really worth £10 million? Okay, is that too expensive? Should I be asking for more equity, or should I be trying to get a discount? What's going on here? Let's move on now. So we go down the page a little bit, all right, and we look at current raise. Okay, so we said before that they want to raise £1 million, yeah? Now, how much of that have they raised so far? Okay, now let's say that they've actually raised, half of that. So they've raised 500,000 from another investor. Okay, so they've raised 500,000 already from let's say it's a VC firm. Okay. All right, and they also have raised 100,000 from previous investors. Okay. All right, meaning that there is 400k left for you to take up. Okay, so what does this mean? The equity left for you to take up is about 3-4%, all right, of that total raise. So other investors involved in the deal is always a good sign for me, especially if there is something called a cornerstone investor, which in this case is this VC firm here. Who this VC firm is also important. Is it a reputable firm? What investments have they made before, and have they actually succeeded? Another consideration is who else is looking at this opportunity. Previous investors is also important because it means that the previous investors involved in past rounds are actually following their money, you call it in this industry. Okay, they believe in the business and they're putting more in. Okay, so they're happy with where the direction it's going. Okay, so this is all good signs to look out for. And next, we're going to move on to major shareholders. Now, this is where you write who the current cap table involves. All right, now there are only 5 fields here, and I appreciate some companies have cap tables of hundreds and hundreds of investors, but here we just want to put the main ones. Okay, this is just to give me an overview of who these shareholders are. Right, so John, the CEO of the business, let's say he owns 400,000 shares. okay, which means he owns 40% of the business currently, okay? Then we have Paul. Let's say Paul owns 300,000 shares, which means he owns 30%. And then we have Ringo, who owns 150,000 shares, so let's say 15%. And then finally we have George. You can see where I'm going with this. Oops, what's happened there? George, who owns another 150,000 shares, 15% of the business, okay? The so what you need to ask yourself here is, who actually are these people, you know, that own the business? Okay, what have they done before? All right, how invested are they in it? Are they silent shareholders? Are they active shareholders? Are they involved in a company or not? Okay, these are all so whats that you can start extracting from this exercise. Let's look at the previous funding rounds. Okay, this is super important for me because, you know, sometimes you get businesses in who, you know, have raised money before, you know, and haven't actually done anything with it. You know, some have done excellent and wonderful and brilliant things with the money they've raised, some have not. Okay, so this is important to see the growth of the business so far. So let's say in 2020, Saw the Skies Limited raised £100,000, you know, at a valuation of, let's say, 1 million. Okay, all right. Let's say in 2021, it raised £500,000 at a valuation of what should we say? We should say valuation of 5 million. All right, let's say. Okay, and so now this round in 2022, as we know, it's the metrics above. So let's just do a little dotted line here. All right, it's a 10 million valuation. I'll probably put val there so you don't get confused. And they're raising 1 million. Okay, so we can see that they're all up rounds. All right, what you want to look out for is if there are any down rounds. Okay, so if they raise money at a lower valuation than they did before, and you can start questioning and asking why that is. Okay, so now we have these main commercial metrics sorted. All right, so now we want to go down to the summary box. The first thing here is business model. Okay, we need to know, you know, typically, like, what is the general business model there? Let's say what they're doing is direct to consumer sales online and also in-store retail. Okay, retail in-store. All right, let's just say that. All right, but obviously you've got different business models out there. You might be a software as a service model, advertising, okay, the list goes on. All right, but let's just keep it simple. And now we're going to look at the summary of this. Okay, so this is just 2 to 3 sentences summarizing the business. I have a rule that if I can't explain a business to a 12-year-old, then I do not understand it enough, or it's not being presented well enough. Okay, so this is what you need to understand. All right, what exactly is the business model in summarized? Okay, so I'm just going to make it really quick here. You probably want it a bit longer than what I'm going to do, but this is just as an example. So I'm going to say it manufactures jetpacks and sells them online and in stores, okay, across the UK or something. All right, as I said, you want it longer than this and a bit more in depth, but this is just an example. Okay, so that's it for part 1. I really hope you enjoyed the first part of this series on how to evaluate a startup or potential business for investment. In the next video, we're going to cover a bit more about the market, the USPs, who the team is, and also look at a snapshot of some of the financial statements or forecasts a company might provide to understand a bit more the financial health of the business. If you enjoyed this first video, please do subscribe. And remember, this is a free guide that I've made. All you have to do is put your email in on my website, and you will get it sent to you. Take care, everyone. I'll see you all soon.